What's going on, guys? Bryant here. Today is Friday, October 22nd, 2021, and the market is closed. Jumping right into it, I want to show you guys that there's a much safer way to trade same-day expiration options or any type of weekly options for that matter. We'll be looking at a case study using Tesla. I took a trade on it today, entering here and exiting on this candle here. But like most of the videos on this channel, it's not about necessarily the trades I take. This just so happens to be a video in which I can showcase how I use what's called a calendar spread to take a very safe trade on a very volatile stock such as Tesla. On the right hand side is the same week expiration. So in other words, the option that expired today, this is the 910 call. 910 was my target. And then we'll be taking a look at the option that expires next week, also the 910 option. So before we jump into the intraday time frame, let's actually just take a look at Tesla on a larger time frame. So we just broke out through all-time highs. This video is not going to be so much about the technical analysis and the nuance of things, but I feel obligated to show you guys what it looks like on the daily time frame, because whenever you come into the day, you should have some sort of an idea as to why you're trading it. So Tesla obviously was on watch because like a lot of other traders, they just reported earnings, and then yesterday it had this huge day. I happened to have missed the entire trade yesterday. However, it came in today and was able to catch a small piece on a relatively safe trade. Next, if we jump into the volume profile, let's take a look at something. I mentioned in the previous video when I was showing you guys how to draw out supply and demand zones, I mentioned looking out for B and P profiles. So this is what's known as a P profile, and it's usually an indication that there will be continued buying into the next day. However, the P did form below the 900, so that's why I decided not to swing Tesla yesterday, but I did come in today expecting there to be some sort of a morning dip buy opportunity. So we will draw out what would be the point of control. If you guys have seen any of my other videos, you would know at this point I trade using points of control. I always look at the volume profile, and then I have an algorithm that I use as a point of reference and also for confluence whenever I'm trying to enter a trade, in which we will be taking a look at that also in a few minutes. So I'm just going to label this here. POC just stands for point of control, and just press enter so it's on my chart. Then let's jump to take a look at what it looks like on the 30-minute time frame. So I use the 30-minute time frame to draw out my points of control. Link to this custom TOS study is in the description if this is the first time in which you're seeing this. And right off the back, from a technical analysis, if you're ever looking for a trade opportunity and you're looking at the volume profiles, and again you see a P profile, in this case it's pretty clear. You didn't even need to look at the profile to see that this was a beautiful pattern here that formed on Tesla. If you're just trading off of technical analysis and you're just looking for patterns, usually what's called the apex of a triangle right here is more than likely going to end up being a point of control. So if you ever want to save yourself time of drawing these things out, just know, again, whenever you see any type of triangles forming, especially symmetrical ones, that apex, which would be the tip right at the end of the triangle, is going to be a point of control. Now let's jump into an even smaller time frame right here, which would be the 5-minute. These zones that you see on the chart, so everything that you see on the chart except for the 900 level and the point of control in which we drawn in, is actually generated from the Quant Trading App algorithm. Full disclosure, I am the lead developer on the algorithm. Link to Quant Trading App is in the description down below if you want to learn anything more about it. So what we have right here is our weekly sell zone, and if I was to actually just put the after hours data on, it's pretty much saying if Tesla was to come into this level, it's more than likely to be resistance. Again, they did have earnings this week, so whenever there is earnings, these levels are pretty likely to break. However, they still end up being key levels to use to risk off of, as well as enter trades on breakouts and things like that. Now, the levels that come from Quant Trading App are quantifiable, so if we actually just jump over to the Quant Trading App website real quick, let's take a look at something. This would be the dashboard to the website, and we have Tesla right here. So what I'm going to do is just pull up the open, high, low, close table. We'll jump right into this, and it's quantifiable, the support resistance that pops up from the algorithm every single week. In this case, we have data on Tesla saying that only 22.5% of the time does it touch its weekly resistance. On top of that, how many times has it actually broken past its resistance and closed above it? It's pretty easy to see right here. So we see this column that says resistance breach. This is 1, 2, 3, 4. All I'm doing is just looking at how many times the resistance was breached and how many times did it actually close outside of its range. If it's green, that means it actually closed within its support and resistance, which is perfect for iron condors, which is just another complicated option strategy that most people like to use if you're market neutral on a trade. But in this case, let's count it out together. So we see we broke resistance, closed outside of resistance. So this would be 1, here goes 2, here goes 3, here goes 4, and what do we have here? Here goes 5. So this was resistance, it closed higher than it, so that's 5 times. This time it did not close above the resistance, so 5 times. So 5 It's 5 times. We're now 41 weeks into the year, and only 5 times did it actually close outside of the resistance that we see here. So that's pretty significant coming in, knowing that information, because in other words, it's saying that it's pretty rare for that to happen on Tesla. And more than likely, if it's over its weekly resistance, it's more than likely going to go higher, especially when there was a good catalyst such as earnings. On top of that, the algo actually gives us trade ideas towards the end of the week. So actually yesterday, it said that Tesla was going to go to 880. So let's just head over to the Discord real quick and take a look at yesterday. So here we are. I'm just going to scroll to pre-market, and let's see actually what the algo says. So pre-market, this was yesterday at 8:51 a.m. This is what the trade ideas tab looks like on the Quant Trading App site. It printed out this information for us right here, and it was saying it had a bullish target of 880. At this point, Tesla was only trading at 851, and this right here was the strength. In other words, how confident the algo was in Tesla. It was pretty confident. 100 is the highest score in which it can have. And to be honest, when I saw this, I was just like, okay, it's probably going to head there, but maybe not. I was a little bit indifferent towards it. So if we just scroll right here, let's just take a look at what my game plan was. We have it right here. So the algo is bullish on Tesla, but that's because it doesn't account for earnings. So I was actually waiting for it to pull into this level right here before going long. But what ended up happening yesterday is it just opened and it just ripped right up to the target, and then it put in its flag over this level. So instead of feeling too bad about it, I just came into today being prepared, saying I won't let another good opportunity pass, because I already know this type of trading activity is pretty rare for Tesla for the year, and that's the benefit of having some sort of quantifiable method whenever you're trading. So if we jump back to the chart and we take a look, this was it right here. This would have been the level or the target for it yesterday. So it was well over its target, and then we took a look at the data. We know that this is very rare for it to be spending this much time over the level. So that's where the trade idea came into today, expecting it to go a little bit higher, or at least have a clear level to risk off of. This right here is the 2-day anchored VWAP, and I love taking trades around the 2-day anchored VWAP because it makes it feel safe. So yesterday, Tesla did not pull into the level in which I wanted, so I missed that trade. Today, it did not quite come down to the 2-day anchored VWAP. I'm going to turn the pre-market data off, because once the bell rings, I generally don't look at that information. So it didn't quite pull into it. So I sat patiently and let a lot of this price action settle in before deciding to take my trade. The gray level that you see on the chart right here is VWAP, just a regular VWAP. And this 900 level is pretty significant, because this, if we go back to the all-time highs, or we go back to the daily time frame, we can see that's where 900 was, and everyone was expecting some sort of move around 900. So again, the majority of Wall Street was probably watching Tesla, and that's something you want to take note of if you're going to be trading a stock. You want to trade something that's called in play, which means a lot of other day traders are also watching it, and 900 is just a nice clean psychological level to be watching. So jumping back to the intraday, now that you guys have a little bit of context, I just want to explain a couple other things right here before we get straight to the options, and you guys can see the strategy in which I used. This right here, clean retracement to the level yesterday, that shows a lot of momentum. And usually whenever I see this, for any of you premium members in Quant Trading App, if you're watching this video right now, remember this: whenever we break out of a weekly resistance level, go check the information, see how many times it's done that, and then know if we come back to this level and it's showing confluence with yesterday, it was VWAP. These are also really good places to take trades off of. So don't necessarily feel bad if you miss out on the big move. There's still going to be a lot of clean moves that can present itself if you just know what to look for. Up here we have 2 sigma. I won't bother explaining that in this video, but I want to mention this right here. So this gray zone is actually also generated from the algorithm, and these are the intraday levels. So we have weekly levels, but then we also have these intraday zones. So I'm aware of Tesla. The algo was saying that 910 was a pretty reasonable place for Tesla to go to today. So I used that as my target. So that's where my levels came from. I didn't have to use any other technicals. I wasn't aware of if there was any trend lines up there, or if there was any resistance levels from the daily. At this point, we were at all-time highs, so we're in price discovery mode, so there was no actual levels to use as a target other than the levels that the algo gave, as well as looking at the open interest and volume on the options chain. So using that, we'll just jump. That's actually a good segue to jump right into the comparison of the options. So on the right hand side, this would be the 910 call for today. So in other words, we know this is our strike because this is where the algo is saying we can likely go to. If you don't use some sort of algorithm, you can use any type of method. You can say that 910 is the next nice psychological level from 900, 905, and then 910. But if there's anything we know about same-day expiration options, is they're more than likely going to end up expiring worthless. And that's just because time decay is so harsh, because this contract only has X amount of hours It doesn't even have a full day to actually have some sort of intrinsic value. Now, whenever you see the price of an option that's out of the money, that means it's all extrinsic value, which means it's actually not worth anything unless it goes in the money. So in order for this option to be worth something, Tesla needed to go higher than 910 by the end of the day. This ends up being a great option to short, not buy, but a lot of new traders come in and like to trade same day expiration options without knowing that there's an easier way to go about it. So if we take a look at the next week's 910 option, we can see that this traded very nicely here. It went all the way from $14.50 all the way up to $19.50. Now, if you're looking at this and you're saying this is pretty expensive, this is where spreads come into play, and the spread that I use today is what's called a calendar spread. So I'm aware of Tesla having high probability of going to 910 today. However, I did not want to buy the 910 call because there's too much risk involved in terms of holding it. And I'm not necessarily a micro scalper most of the time. I like to get into positions that I can comfortably hold for a while, at least 30 minutes, sometimes for the whole day. And buying a naked option with time decay, it makes me uncomfortable sitting in that position. So let's actually just put the info on the chart, and I want to break down the cash flow for how this trade worked for me. Here's the entry, here's the exit, and this right here is just to show you guys the fills. Again, it's not necessarily just about my trades and things like that. That's not the intent of this channel, but I do want to show you guys exactly where I got in and where I exited. So you can see 946 is where I entered and 1031 is when I exited the trade. So right here, I got filled for $11.35 and I closed the spread for $14.25. So it was about a 25% made in profit. If we take a look at how the spread works, you guys can see, so October 22nd, which is the same day expiration, when I opened it, I actually shorted that contract, and I shorted that contract for $3.72. And at the same time, I bought next week's 910 call, and this is how much I paid for it. So the difference between these two would be the cost of the spread. $15 minus $3.72. I'm just rounding out the prices, equals this. And then at the same time, later when I went to close the trade, I had to buy back the one I shorted, and then I sold the one that I purchased, and this was the price here. So we're going to break down the exact cash flow, how this works. It's a trade that has positive theta, which is something that I really like, but I just wanted to show you guys. You can pause it right here. You can go back and take a look at how this actually played out. This is showing by the end of the day, which is when I took this screenshot here. You can see that the bid and the ask for this option was worthless. It expired worthless because Tesla did not close over 910. We jump back to the chart and we look at it actually on the chart right here. You can see this is the same information. This call expired worthless. Let's turn on the info for this chart here and we can see it. So let's jump. Now that you guys know the time in which I marked it on the chart, so you can actually see where I entered the trade and when I exit the trade, and then the price in which I shorted it, in the price in which I shorted this contract was going for $3.72. Just to confirm, I believe it says it right here, $3.72, so you guys can see it nice and clearly. Put it on the chart so I don't have to go back to show you guys the exact orders. Then next, let's just put on our studies over here, so now we can see what we were looking at, where VWAP was, and so forth. So just zoom in right here, make it nice and clean. So here we go. So 945 would have been right about here. 946, sorry, would have been right here. So these are 5-minute candles. 1, 2, 3, 4, 5. So right during this candle here, I liked how Tesla was holding over 900, as well as VWAP being a clean level to risk off of. Now, when I entered this trade by shorting this contract for $3.72, that means I would have received credit, in other words, for selling that contract. So someone would have paid me $3.72 because they purchased it for me. Guys, by the way, you can do this on Robinhood. You don't need a complicated platform. I did this trade on Silex, but I also use Thinkorswim, and you can do these types of spreads on Robinhood. I'm not going to show you how to actually enter the orders. Actually, you can probably just search that on YouTube, how to open up a calendar spread. But just know this type of spread that I entered is called a calendar call spread, and all that means is that I shorted strike price, and I also purchased the same strike price for the further expiration. So that right there is the logistics of how it plays out. But again, this right here would be how much I'm paid, so $3.72. Now, because I had to buy another contract, how much did that cost me? It would have costed me the $15.07, as I showed you guys in the other slide when I actually purchased the order. So here would be where I got filled, and then here would be where I closed the trade up here. So let's take a look at how Tesla moved. It went from here, it hit the target, and then it pulled in. As soon as it pulled in, this is where I essentially closed the trade. I waited 1 minute after just to see if it would go a little bit higher. Now, if you were to be trading the naked option, and let's zoom in right here, I want you guys to see something. So between the time I was in the trade, which would be here, and the time in which we closed the trade, which would be here, this option essentially went nowhere. It made pretty much no money. That means if you bought this call here and you were up watching Tesla go up, all it would have taken was this little slight pullback right here for you to pretty much lose all your gains. I want you to think about that for a second psychologically. Imagine, first of all, being down this much, because at the time in which I entered it, it actually wicked down a little bit lower. So imagine, what do you think you're going to do psychologically if you are buying this option and then you see within 1 minute it drops all the way down here? We're looking at a 1 minute time frame for the option and a 5 minute time frame for the underlying over there. So within 1 minute, your option goes from $3.70 all the way down to $2.20. Psychologically, that's going to destroy you, especially since you're looking at this and you're like, oh man, this is a really nice bull flag, because at one point this candle didn't look like this. It probably looked even juicier because it was actually up here. It looked pretty green, or however it was looking in the moment. You're probably looking at the tape. You're seeing that the 900 level is holding. You're seeing the bid stepping up. You enter this trade and then instantly, boom, you're down. You're more than likely to stop out of this trade taking a loss, right? I mean, you can't blame yourself for doing that. Now, if we take a look at next week's option, let's see, assuming buying this at 15 bucks and then it actually pulls in to 13.50, this play is not nowhere near significantly down as much from a percentual level. And especially since the fact that this option still has a week left on it, you're not more than likely going to just stop out of this if you're coming in with a clear head and a good trading plan. Now, when you enter in some sort of a spread, you're actually going to be looking at your P&L not really even turn red, because how much this option is going to lose in value is so fast and so drastic compared to the option that you're actually long. And since you're short this option and you're long the other one, your P&L is not going to look that bad. I'm going to demonstrate that real quick for you guys right here. So if we come to, this is a platform OptionStrat, which I use whenever I'm analyzing my options. And I want you to show you guys, this is from the time, unfortunately, when the market closes and the options expire worthless, OptionStrat does not allow me to show you what I would have been seeing. So we're going to take a look at, this is if you were to enter the same type of spread for next week. We can analyze how the price actually moved right here. But since I can't show you guys what I was actually in as October 29th, it's not the contract I shorted. I shorted October 22nd. It's saved right here because it's in my expired save tabs, but I'm going to pull this up and you guys can see this is actually when I entered it, and you can see how the P&L performed. It actually only hit a low point of negative 4.7, and that was like instantly after entering the trade, but then you can see it was just green the whole way through. If I held all the way until close, the spread was actually up 58%. So I closed the trade when I was up around 25%, which would have been right around here, but no harm, no foul. I just wanted to make sure I was locking in some gains, as I didn't have the best trading week. So I was happy to come in with a clear head, and it wasn't necessarily about just putting up a huge P&L today. It was just about making sure I did the right thing. So now that we're back at the charts and you guys can see a drop like this means I was only down 4% essentially on the spread. If we pull up back to the option in which I was long, I have it outlined up here how much it costs to open this spread. It cost $11.35. If that seems like a lot of money to you, when you enter in these types of spreads, sometimes I end up just ignoring that because I know my risk on this is probably only going to be about $100 or $150, even if I'm giving it a huge room, because even if Tesla was to pull in a little bit deeper, the spread would actually not lose that much, because the option that I'm long for next week is not as sensitive to price action for the contract that expires today. So in a sense, if I was down at max point, let's just say I was even down negative 5%, and my target I knew was going to be around 25% of the spread. When you're using the Analyze tab in Thinkorswim, or you're using something like OptionStrat, you can actually see what your potential profit will be before you enter the trade. You can also enter the trade and then go analyze, if Tesla was to get to your strike price, how much would you actually be up? So I knew I was going to be up roughly 25% before I entered the trade. So being down, even if I was down 5% at one point, that's risking 5-to-1, which is great risk reward ratio. Even if I was risking 10%, that would have been fine, because I would have been able to give it a lot of wiggle room. That's something you can't do when you're trading 0-day options. The moment you're in, if the trade is not working in your favor, you're almost obligated to close the trade right away, just because of risk management. So I mentioned we'd be taking a look at the cash flow. Look at how this played out here. So if I bought this contract for 15 bucks, I'm just going to ignore the cents because it's going to get annoying repeating the cents over and over. So assuming I bought this contract for 15 bucks and I closed it at 18, that's a $3 increase in this option, right? Same time. So buying this option here and closing it here, that's $3. But we just talked about, if we were in the 0-day and I bought the option here and I closed it here, you guys see how ridiculous that is? It would have been a loss. Again, imagine being right on the direction and being wrong in your P&L, how frustrating that is. And then if you tell yourself you're going to just hold it, take a look at what happens here. This option never went back to this value. It just got crushed, and that's just because of time decay. So because I was shorting this option, I didn't have to worry about what was going on over here. When you enter these spreads, you're actually not managing the individual contracts like this. You're just monitoring how the spread is doing overall, and your platform is going to tell you the overall price. So for educational purposes, I'm showing you the individual options so you can see, but it's not as complicated as I'm even outlining it to be. If this video is complicated so far, I promise you it's not this complicated when you're actually doing it. If you were going to look to open a spread, you would actually just right click on this on a platform like Thinkorswim. You would go to buy, and then you would just say like, hey, I want to buy the calendar spread. And if you press calendar, it'll pop up and it's telling you that's the cost of it. And then you would just press confirm and send, and then you're in the trade. So it's automatically saying we're going to be long the contract for November 5th, and we're short the contract for October 29th, which is the closer expiration, which means theta is going to hurt this contract faster than it's going to hurt this one. And that's why it's a positive theta trade, which makes it a lot safer to be in. Let's just close this out and then look back at here. So now let's just look at how things ended up playing out later. Tesla pulled back, and assuming I held all the way for this pullback, even if I held it below 900, at the point when this reached all the way down here, this option was now going for 50 something cents. So if I shorted it for $3.70 and it's all the way down here, that means I would be up $3.20 on this spread essentially. Right? So I'll be up $320. Now, if we go to the contract in which I'm long on, if I bought this contract for 15 bucks and now it's going for $12.50, I'll only be down $2.50 here, but I'll be up $3 on the other contract. So overall, I'll actually be up 50 cents or $50, even though I bought Tesla. We opened the spread here, and now Tesla is below where we opened it. Spreads like this are essentially, you're going to remain positive on the trade as long as Tesla stays above a level like this. And as long as it stays above a level like that and it stays below a level like this. So you have such a wide room for profitability. And as long as it remains at your strike price by close, that's your maximum profit. So your P&L chart looks something like this to this being your maximum profit wherever your strike prices are, and then it kind of tapers off. But anywhere in between, you're actually profitable, which is why I love trading these towards the end of the week, because I don't have to be so pinpoint accurate. Now, if we come back to OptionStrat and we actually take a look, this is what the P&L graph looks like. So if we were to enter the same spread, and this time we're going to short October 29th, which would be this contract right here, we can see how does this actually work? It sounds like some sort of wizardry. It's just because the theta right here is much higher. So the theta will be plus 1.29. If I was to buy this contract, the theta would actually be negative 1.29, but because it's it's positive 129 because we're shorting it, which means the person that's buying it from us is actually going to be losing $1.29 every day for holding this contract in theory. But then we're going to be buying this one, and the theta for us is only negative 0.92. So in other words, the difference between the two ends up being a positive theta for us, and that's what's showing out, and that's what's showing right here. So plus 36 in a sense is showing if none of the other Greeks are affected, this spread is essentially going to make 36 bucks a day. Each day it's going to change because it's going to start making more and more money as it gets closer and closer to Friday, which would be the expiration right here. And then if you want to know how much does a spread like this cost, it's essentially going to be $798. Why is that? Because we're shorting this strike and we're collecting $17.77 in premium, and then we're buying this one for $25.75. So the difference between the two actually ends up being our net debit, which is how much BP you need or how much buying power you need. And if Tesla was to actually close right at this strike price next week, this is how much you'd be up, a little over $1,000. So you'd be up more than 100%. If Tesla was to close, even if it closed around above 900 and below 920 next week, you'll end up being up still about 500%. Now, again, these numbers do fluctuate and they change because the implied volatility changes. The VIX moves around, and that will affect calendars. The thing I really like about calendars, especially for the time which we're in right now, it has a positive vega. That means if the VIX increases, the calendar spread will also increase. Even if Tesla was to pull back, if the implied volatility was to increase because of the VIX rising or something like that, you'll actually end up making more even if Tesla pulled back. So let's just say Tesla pulled back to 900. we would be up $775. If I just put this back to how it was before, if Tesla pulled back to 900, we would only be up $560 something. So up a little bit more if the implied volatility increases. And if you know anything about trading options, implied volatility increases usually when prices are tanking because of fear kicking in, which is essentially another way to think about what the VIX is measuring. So coming around to the conclusion of this video, we can see at the end of the day, this option expired worthless, which means if I shorted it for $3.71, that would mean it's essentially $3.72 or $372 profit made from this option just by letting it expire worthless. So if we made $370 here on this contract, how much would we be up? Because it actually closed here, we would have made almost $300 on this option also. So you add the two up and it ends up being up almost $600 overall, just for letting Tesla close around our strike prices. This is an ideal scenario. It's not always going to close exactly at your strike price, but as you guys saw before, it could have closed anywhere between here and here. It had a wide room for profitability. And that's why I really like these trades. I highly encourage you guys to trade calendar spreads, especially if you're now starting out trading spreads. You're completely new to this and you're nervous. It's very hard to mess it up. They're great for swing trading as opposed to swing trading naked options or some of the other options like vertical spreads and things like that. You need to be a little bit more accurate. And even if you're looking at this and the BP still looks like it's too much for you, you didn't necessarily need to trade the exact spread in which I traded. You could have done something like trading the 920 strike. If we take a look at how that would be, say for example, next week, the 950 for Tesla is something you want to trade. Guess what? This is only going to be $500 something in BP, right? Come Monday, this will probably be a little bit cheaper. And you can go as crazy as even if you wanted to go all the way out to the 1,000 call right here. See, $240 to open up a trade like this. That's what the net debit is. And obviously you don't have to be thinking Tesla is going to go to 1,000. You might be closing it if net Tesla goes to 930. All at the end of the day, you're still bullish on the trade because your delta is positive, and that's the way you would interpret this. And as you can see, you can be in a trade like this, remain with a positive theta, so time decay is not going to be hurting you. Now, granted, even with a spread like this past like maybe Tuesday, even Wednesday, the theta will start turning negative, but that's just because you're so far out the money. So I wouldn't encourage you going that far out the money when you're trading something like this. You'd more so want to keep it to about, this is pretty good. So if Tesla's trading at 910, which is about 910, which we closed, this is 40 points higher. This is not a bad spread to be in because if Tesla closed at 920, you'd end up making about $180. So if Tesla closed at 925, you end up making $300, which is well over 50%. So it's still a good trade. And if Tesla was to close at 910 next week, you'd end up being down about $60, so less than 100. So you're still risking 1 to 3, and you don't have to be freaking out because of watching your P&L just keep bleeding out because of time decay. And then you can understand, even if Tesla wasn't moving, you can actually still be profiting just because of the time decay actually working in your favor. If you have any questions, leave comments in the description down below. If you're new to my channel, like the video, share the video, subscribe to the channel, and then feel free to join my Discord. There's a premium section, but there's also a public section that's available for anyone. You guys can come in there and ask questions. I'm really trying to help you guys understand that there's safer and better ways to trade options, especially if you're new. When I first started trading them, I wish I was exposed to these types of videos. I wish I was exposed to more calendar spreads. I don't believe there's a lot of calendar content out there. The vertical spreads tend to get a little bit more attention just because they're the core building blocks to a lot of option strategies like iron condors and some of the more popular credit spreads like put credit spreads. But this right here is actually my #1 recommended option strategy. And since I actually had a tough week trading this week, I'm going to go back to be opening a lot more of these. So expect to see a lot more content around calendars, as well as because of the fact that the VIX is so low right now. I would like to capitalize on if the VIX was to spike. So lastly, for you guys that don't use an algo, you can use something in the options chain such as the open interest to pay attention to your strike prices. So if next week we see that there's a lot of open interest right here for the 900 call, on Monday morning, let's take a look and see if there's a lot of open interest for another strike price that opens up. That ends up being a good target right here. So if Tesla looks like it's going to go to 950, it makes sense. It's another nice halfway to 1,000. This might have a lot of open interest. It's going to have a lot of volume. However, Tesla is not very likely to close over 950 next week. So that means this is probably going to be a good contract to short, because if you sell this right now, you're going to collect $5 in credit, and then we would need to buy the further out one. So the November 5th, we would short this one right here, the 950, same thing. And instead of buying this one for, we would have to buy this, instead of buying this for $11, because we shorted the other one, it's only going to cost us $5.68 to open this spread. And if Tesla closed below 950 this week, we would collect 100% of the credit for this one, and then we'd allowed to continue to hold our 950 call into the following week. You guys already see how even better that is for swinging options. So I feel like I'm going on a little bit longer than I intended to do. This is another video I thought would have been just 10 minutes long, but hey, I can't help it. And a lot of you guys have said that you're enjoying the longer videos, so I'm not going to necessarily, so I'm just going to keep doing what I guess feels natural to me, and I'll just listen to you guys' feedback. So thanks for watching, and I'll see you guys in the next one. Later.